Trade. 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 WeMasterTrade.
Hey there, WeMasterTrade family. Welcome to an electrifying session to the next level, and you're excited pro to start. You're in the right place to sharpen your skills, expand your knowledge, and supercharge your trading game. So drop a message in the chat, let us know where you're tuning in from, and don't forget to smash that like button if you're ready for an action-packed session. So this community is built on passion, learning, and growth. So today we are here to push the boundaries together. So we have an incredible lineup, including some of the sharpest minds in Forex and fund trading. So you definitely get into the insights, battle tested strategies, and the kind of real-world wisdom that can transform the way you trade. So let's get your notepads ready, because today's session is going to be pure gold. So let's dive right in. So I'm free to introduce our first guest, a trader who has been making serious waves in the Forex world. He's got a track record of precision, discipline, and successful. So please welcome Alex.
So hey Aidan, I'm feeling fantastic and great to be here. It's always wonderful to be engaged with WeMasterTrade community, and I'm eager to delve into some strategies that I've been applying in Forex market. Thank you.
So I love that energy, Alex. I know that the audience is bummed to hear all about your Forex journey. But before we get into that, let's not forget about our next guest, Rav. So Rav's been dominating the fund trading scenes, especially in the high-stake world of crypto and stock. So Rav, how's it going?
So hey, Aidan, I'm equally excited to be here. This section always offers fresh topics for discussion, and today I'm thrilled to share some of the strategies that have been effective for me in fund trading. It's going to be an engaging section.
So that's what we love to hear. So for everyone watching, make sure you've got your notepad ready because Alex and Rap are about to drop some serious knowledge bombs and we're diving deep into their experiences, challenges and these strategies that will help them thrive in the fast-paced world of fund trading. So Alex, let's kick things off with you. You've been trading in Forex for over a year and a half now, and I know that the Forex market can be a bit of a roller coaster. So can you tell us how you got your start in Forex trading and what led you to choose WeMasterTrade as your platform?
Thank you for your great question, Aidan. I began Forex trading about 2 years ago, and what captivated me actually was the market's privacy and activity. The Forex market is exceptionally dynamic, and I was attracted to the concept that there's always potential for success regardless of the circumstances. When I first discovered WeMasterTrade, it immediately resonated with me as the perfect match. The resource they provide, including sophisticated technical analysis and access to real-time data, truly impressed me so much. However, it was the community aspect that inclined it for me. WeMasterTrade places a strong emphasis on aiding traders' success by offering essential tools and support to advance regardless of your starting point.
That's fantastic, Alex. It sounds like WeMasterTrade has really helped you evaluate your game. Now, Forex is known for its volatility, and sometimes it can make or break a trader. So how do you handle the ups and downs of the Forex market without letting the pressures get to you?
Sure, great question. Volatility can be challenging to me, but it's also when the real opportunities are. The key is having a solid risk management plan, and I always say you have to respect the risk. It's important to stay disciplined, and WeMasterTrade risk management tools actually help me to do that. And their real-time alerts and customizable risk parameters allow me to react quickly but with control. When the market moves fast, you have to stay calm, trust your strategy, and not let emotions take over. As for me, that's where WeMasterTrade features really shine.
So that, I believe, is some seriously valuable insights, Alex. Managing risk and staying cool under pressures is definitely key in Forex trading. Now, let's switch gears to fund trading. You've been crushing it for nearly 2 years, specializing in long-term strategies. So can you tell us what drew you to fund trading and how it differs from other forms of trading?
Absolutely, Aidan. Fund trading revolves around strategic long-term growth. It's not about seeking quick wins, but constructing a portfolio that can steadily advance over time. What truly distinguishes fund trading is the need to consider both short-term and long-term perspectives. Careful risk management is crucial, while simultaneously keeping an eye out of emerging opportunities. WeMasterTrade real data and analysis tools have been instrumental in achieving this balance. They enable me to make well-informed decisions that align with my long-term strategies, even when the market presents unexpected challenges.
So I love that. Fund trading definitely seems like it requires a lot of patience and foresight. So how do you stay focused, on the bigger picture, especially when the market gets, a bit rocky?
Well, patience is paramount in fund trading. The market experiences fluctuations, but short-term ups and downs shouldn't dictate your long-term strategies. A crucial lesson I've learned is to maintain emotional detachment. Don't get overly excited when things are going well, and don't panic when the market dips. WeMasterTrade risk management tool assist me in staying disciplined. Even during volatility, I can set precise risk parameters and have peace of mind knowing that I'm not overexposed, even when the market behaves unpredictably.
So that's solid advice. Keeping your emotions in check is definitely a big part of being successful in trading. So you both have shared some serious gems so far, but let's talk about the tools that will help you get to where you are today. So Alex, could you share one specific features of WeMasterTrade that's been a game changer for you in Forex?
Oh, definitely. A tool that I absolutely rely on is the account insights feature. It offers me up to the minute data on how my account is performing, and I use it to observe patterns, evaluate my trades, and make better informed choices, whether pinpointing the best time to enter the market or deciphering market trends. This tool actually gives me an edge, and it has enabled me to spot opportunities that I may not have noticed otherwise.
So that sounds like a total game changer. Having a real-time insights is crucial, especially when you need to make quick decisions. So Rab, what about you? What's been your go-to tool in farm trading?
Well, for me, it's all about the risk management tools. They allow me to customize the amount of risk I'm willing to take on any trade. This has been a key for me, especially in volatile markets like crypto. WeMasterTrade helps me stay disciplined and in control, ensuring that I never take on more risk than I'm comfortable with. That's what keeps me grounded, even when the market is going wild.
So risk management is so important, especially in today's fast-moving market. So whether you're in Forex or farm trading, having the right tools makes a world of difference. So I hope that everybody is taking notes because Alex and Rav are dropping some serious pro-level insight today. So traders, we are going to kick things up a notch because it's time to dive into one of the most powerful features here at WeMasterTrade, the package comparison. So I believe that whether you are a seasoned, a fresh pay newbie eager to get your feet wet, or a seasoned pro looking to scale up your game to new highs, this segment is for you because this is where you find the perfect trading package to match your goals and take your trading from good to great. So now let's be clear. Here at WeMasterTrade, we know there's no one-size-fits-all in trading. Every trade is unique with different style, risk tolerance, and strategy. So that's why we offer multiple customizable packages to meet you exactly where you are in your trading journey. So whether you're aiming for high risk or high rewards, or you prefer the steady, methodical approach, there's something here for you. And to break it all down, I've got the awesome Rab and Scarlett. Ralph and Alex, two of WeMasterTrade partners, so they've worked closely with these packages and are here to give us the inside scoop on how to leverage each one to its full potential. So let's jump in, Alex. You've been with WeMasterTrade for a while now, and you've seen firsthand that these packages can evaluate a trader's experience. So can you kick things up by walking us through how both new and experienced traders can benefit from the packet comparisons, and why is it such a game-changing feature here in the WeMasterTrade experience?
Oh wow, I really enjoy discussing these packages because it's when traders can truly customize the experience. The packet comparison feature simplifies the process for traders to understand precisely what they are getting. When you visit the website, there's a detailed comparative overview for each packet that includes information like the initial balance, the profit targets, the loss limit, or more. And all the essential details are presented in a straightforward, easy to navigate table. It's all structured to assist traders in selecting the best tool for their success. So let's talk about the standard one. You can visit LiveStream. While the most popular option for our traders, this one is great for traders who've got experience and are ready to lever themselves. You start with an initial balance of up to $200,000, which gives you plenty of room to trade confidently and make strategic moves. The profit target is set at 6%, which is perfect for traders aiming for steady, sustainable growth, and the daily loss cap is 4%. So you've got enough breathing room to ride out market swings without straining too much. It's an awesome balance between opportunity and security.
So that sounds like a perfect stepping stone for traders looking to level up without jumping in too deep or too quickly. A 200,000K balance and a solid 6% profit target give you a ton of flexibility to build momentum. But for those who are looking for something, a bit more feeling, so let's talk about the 5-10-10 package, Alex. I hear that this one a favorite for high risk, high reward traders. So what do you think makes the 5-10-10 such a standout?
Well, regarding the 5-10-10 package, so now we're talking big plays. Like the standard package, you start with $200,000, but this package is for traders who are ready to take on bigger risk for bigger rewards. The day loss cap is 5%, giving you more flexibility in how you handle the market. But here's the kicker, the profit target jumps to 10%. This is perfect for traders who have confidence in their strategies and are looking to make those major gains. It's all about having a higher tolerance for risk in exchange for bigger payouts.
So that's what I'm talking about, a 5% loss cap and a 10% profit target. That's definitely for traders who aren't afraid to go big and swing for the fences. But what if someone looking for something that is more relaxed? Maybe they want something simpler without all the pressures of a specific point target. So Rob, I've heard about the 5-10-0 package, so can you break it down for us?
Absolutely, the 5-10-0 package is ideal for traders who want a straightforward, no-nonsense approach. You start with a $100,000 balance, but here's the cool part, there is no profit target. You can trade freely without the stress of hitting specific percentages. It's just you, the markets, and your strategies. The die loss cap stays at 5%, giving you some structures, but the beauty here is that it allows traders to focus on consistency without worrying about specific growth.
So that sounds like a dream for traders who just want to trade without all the restrictions. Total freedom, no pressures, just you and the market. Now, but what about those traders who want a bit more control over the risk management but still want to play in that high stake arena? So what can you tell us about the 5-10-10 no PC package?
Yes, the 5-10-10 no PC package is perfect for traders who want more control over their trades. You still get the $200,000 starting balance and the 5% die loss cap, but the flexibility in the real selling point is here. This package allows you to tweak and adjust your trading parameter to match your style and risk management preferences. Whether you're reacting to market changes or want to experiment with different strategies, this package gives you the freedom to adapt without losing the safety net of risk management.
So flexibility and control in a volatile market, that's huge. I love how these packages are giving traders more ways to adapt and grow. So now that we've covered a lot, but up and hearing whispers for something really special, the custom package. So Alex, tell us, what makes this one so exciting?
Well, regarding the custom package, it's where things get really exciting. This is for traders who want it all. Full control, full customization, and a massive starting balance. You get a draw turbine at $1 million, initial balance, and yes, 1 million. But that's just the beginning. The real beauty is that you can customize everything. The day loss limit, the mark loss, even your profit target as well. It's perfect for traders who know exactly what they're doing and want to craft a trading experience that matches their exact needs. It's the ultimate in freedom and control.
So, $1 million starting balance and the ability to customize your entire trading experience, I believe that's next level trading. So whether you're a risk taker or a methodical trader, the custom package sounds like the ultimate playground for those who want to take the trading to the stratosphere. So, alright traders, let's quickly recap. So whether you're just starting with the standard package, going for bigger reward with the 5-10-10 package, enjoying full freedom with 5-10-0, or taking control with the 5-10-10 no PC, or you can choose to customize everything with the custom package, I believe that WeMasterTrade has the perfect option for you. So the only question left is which one is calling your name? So head over to the package listing section on our website right now and check it out for yourself. We've got packages designed to fit every trader no matter where you are in your trading journey. So let us know in the chat which package speaks to you, and our team is ready to help you get started. And I believe that the future of trading is in your hands. So Let's make it happen. So traders, this is where magic is going to happen. So we'll talk about the packages and how you can jumpstart your journey with WeMasterTrade. But let's be real, success in trading isn't just about the package that you choose. It's also about understanding and sticking to the rules. So the conditions that we'll set to you at WeMasterTrade are designed to not only keep you safe, but also help you grow and take your strategies to the next level. Now, whether you're just getting started or you've been trading for years, the conditions will act as your roadmap. So let's dive into the rules to define our trading environment, because if you understand the rules, you can master the game. So first on the list, and arguably one of the most important, is a daily loss limit. So Alex, you've been through it all, the high, the lows. Can you pick things up by explaining to everybody how this daily loss limit works and why it's so crucial for managing risk?
Well, regarding the daily loss limit, is one of the most essential protection any trader can employ. You can take a look at my screen. So here is our daily loss limit definition. It serves as a daily circuit breaker to prevent you from suffering significant losses on a challenging day. The concept is straightforward. There's a limit on how much you can lose in a single day of trading, and it's determined by greater of two values, your account balance and your equity at the beginning of the day. So let me break it down with an example so you can understand clearly. Let's say you got a balance of $105,000, but due to some open trades, your equity, including floating profit and loss, we call P&L in short, is $107,000. At the start of the day, if you're working with 4% daily loss limit, that means you can lose up to $4,000. If your equity falls below $103,000, you are done trading for the day. And the second example, on the flip side, if your balance is $100,000 and your equity is only $99,000, the same 4% loss limit would mean your account will be liquidated if your equity dips below $96,000. The point is, the daily loss limit is there to make sure a bad day doesn't whip you out completely. It's about protecting your account and giving you the chance to regroup and come back stronger the next day.
Got it. So it's like an insurance policy for your trading day. You hit that limit and boom, you're out before things get out of hand. But what happens if a trader accidentally crosses that line? Can they keep trading?
Wow, great question. Well, no, if you break the daily loss limit, your account is automatically liquidated. On your open position will be closed and you won't be able to trade again until the next days, or unless you have to buy a new package to start trading again. Here's the thing, this liquidation is automatic and immediate. It's designed a way to prevent further losses. But here's a word of caution, market fluctuations can sometimes cause you to lose a bit more than the limit, depending on how fast the market is moving.
Oops, so it's a hard start, definitely something traders should keep an eye on to avoid. And now that we understand what the daily loss limit is and what happens when it hits, the next question is how to avoid hitting that limit in the first place. So Ralph, you've been with in the trading trends for years. Can you share some practical strategies that traders can use to stay within their daily loss limit? We're all ears.
Okay, Aidan, staying within the daily loss limit is all about being disciplined and following a solid risk management plan. Here are a few key strategies that have worked wonder for me and countless other traders. First, and I can't stress this enough, always use a stop loss. I know it sounds simple, but it's absolutely critical. The stop loss ensures that if the market moves against you, you are out of the trade before things get out of hand. Think of it as your safety net.
So it's like setting up guardrails on a mountain road, right? It's set to stop you before you go off the cliff.
Exactly, Aidan, is that extra layer of protections. Now the second strategy is position sizing. This is where a lot of traders slip up. You should never risk too much on a single trade. A good rule of thumb is to risk no more than 1 to 2% of your account balance per trade. This way, even if the trade doesn't go your way, you are still far from hitting your die loss limit, and you can keep trading without any major setback.
So it's like building your defense. You don't put everything in one of those play, right? You spread out the risk. That makes sense. But what about those moments when traders feel tempted to chase after the losses? You know, trying to get all back in one trade.
Oh, that's a big one, Aidan. Chasing losses is one of the biggest mistakes traders make, especially newer ones. This brings me to my third strategy: don't chase losses. If you're having a tough day, take a step back. The market will always be there tomorrow. If you start chasing losses, trying to recover too quickly, it's easy to make emotional decisions that lead to even bigger losses. And before you know it, you are hit that die loss limit and you are out for the day.
So true, it's like trying to sprint when you're already wounded. You're more likely to make a mistake. Now, rapid strategy sounds spot on, but how do traders stay mentally strong when things aren't going their way? What keeps them from falling into the emotional trap of chasing losses?
Well, it's all about mindset, Aidan. Trading is just as much as a mental game as it is a number game. You got to stay calm and focused. One trick is to always have a trading plan before you even place a trade. That way, when things get tough, you stick to the plan and avoid making impulsive moves. And if you find yourself getting emotional, just stop, take a break, step away from the screen, and reset your mindset.
So thank you for those incredible tips on managing daily loss. Now let's shift our focus to another critical element of risk management, the maximum loss limit. So this limit is like your long-term safety net, ensuring that you don't deplete your account over time. So unlike the daily loss limit, which resets at the end of each day, the maximum loss limit is cumulative. So when you reach it, your account will be locked and your trade will be closed. So Alex, I know that you've got some great insights into the mechanics of the maximum loss limit. So could you walk us through how this rule works and what traders need to keep in mind as they plan their trading strategies?
Of course. So back to my screen. The maximum loss limit information is here. It's a vital rule that often overlooked but extremely important. Essentially is there to prevent traders from experiencing catastrophic losses by capping how much you can lose across the life of your trading account. So let me break it down into two symbols for you to easily understand. The first, let's say the maximum loss limit ensures your account equity never falls below 94% of initial balance. If you start with a balance of $50,000, your account will be closed once your equity falls to $47,000, and that's the total allowable loss of $3,000. However, it's not on bad news. If you start making profits, the limit adapts, giving you actually more breathing room as your raw equity grows. For example, if your account balance increases to $52,000 and you've now made $2,000 in profit, your new maximum loss limit would then allow you to lose up to $5,000 as you are essentially locking in those gains. The maximum loss limit acts as a long-term safeguard. It's designed not only to protect your account but also to encourage disciplined trading by setting boundaries. The goal is to ensure you don't dig yourself into a hole that's too deep to recover from. Here's a few specific examples. So as I mentioned before, the calculation to figure out where you stand. The maximum loss limit is calculated by adding the sum of your closed positions and factoring in any open positions that are still running. Your trading dashboard will show two key metrics: maximum loss. It means how much you are allowed to lose overall, and remaining loss, the loss left before your account is closed. Now, what actually happens if you hit that limit? Unfortunately, if your equity hits the maximum loss limit, the system will automatically close your account for the day. On your upper position will be liquidated, and whether you are profitable or not, you will be unable to trade for the rest of the day. During some trading, you will need to purchase a new trading package to start it again.
So thanks Alex, that's definitely helped clarify the nuts involved with the maximum loss limit. So it's like a long-term safety net, isn't it? It's there to keep you from spiraling out of control, so especially when the markets get volatile. So next up we're going to enter a short break, and after that we're going to continue with our maximum loss limit rules, and we're going to work you through some of the recent plans that we are currently running.
It's a great question. You're absolutely right. No matter what type of trader you are, ignoring the maximum loss limit can be costly. In fact, it's one of those things that sneak up on traders who aren't paying attention to the long-term picture. And I'd say the most common mistake is underestimating how quickly cumulative losses can add up over multiple trades. Here's some key strategy I recommend to stay well within your maximum loss limit. The first, to set stop loss order on every trade. This is your first line of defense. Setting a stop loss means you are deciding in advance how much you're willing to lose on a particular trade. The system will automatically close your trade if it hits that number, which protects you from letting a losing trade get out of hand. For example, if you are only willing to lose $500 on a particular trade, you can set that as your stop loss and you won't have to worry about it.
copy trade. We copy trade.
Welcome back, everybody. So next up, we are going to address a really important topic that is also really important when it comes to managing your account. So that is the profit consistency rule.
Well, the profit consistency rule is a powerful metric that helps you understand how stable your profits are over time. It's not just about making big gains on 1 or 2 good days, it's about being consistent day in, day out. So you can take a look at my screen. Here's the full detail of our profit consistency rule. So here is how the profit consistency rule is calculated. You take your highest single day profit and divide it by the total of all profits and losses over a given period, usually a month or quarter, and you then express the result as a percentage. Let's go through an example. Let's say your best day brought in $200 in profit, but over the month, your total profits and losses add up to $410. In that case, your profit consistency ratio will be about 48.7%. This ratio shows how much of your performance comes from one standout day. Ideally, you want this percentage to be lower, under 20%, because that means your profits are more evenly spread out across all your trading days. So now, why this is important? A low profit consistency ratio indicates that you are not just relying on a couple of big wins to stay profitable. Instead, you are showing that your strategy works consistent over time. Even on those days when the market isn't giving you big wins, and this kind of consistency is a hallmark of successful long-term trader.
So that's a great explanation, Alex. So just to clarify, a lower ratio means that you're more likely to make steady gains rather than being overly dependent on a few good days, right?
Well, exactly. So when you are too reliant on just a few big wins, it often means that your strategy is risky, inconsistent. You could go through long stretches where you are not making much money or even losing it. But if your profit to ratio is low, it shows that your performance is smoother and that your trading is more predictable and stable over the time.
So awesome, so now that we've got a solid understanding of what the profit consistency rule is, let's dig into some practical strategies to help traders maintain a low ratio, so easily under 20%. So rather know that you've got some great tips for us, so can you walk us through some techniques that traders can use to stay consistent and ensure their ratio stays in check?
Absolutely, Aidan. The profit consistency ratio is a powerful indicator, but it takes careful management to keep it low. So let's talk about some practical ways traders can improve their consistency and avoid becoming too dependent on those rare pick wins. First, one of the most effective strategies to keep your profit consistency ratio low is to diversify your trades. This means spreading your investment across different markets, asset classes, or even trading strategies. If you only trade one market, say forex or stocks, you risk being too reliant on that market's performance. By diversifying, you reduce the impact of any single loss and create more stability in your overall performance.
So that's incredibly insightful, and it seems like a critical metric for any trader who's serious about long-term success, right?
Exactly, Aidan. It's all about balance. When one market isn't performing well, another market might be doing better. This way your overall performance stays smoother and you are not relying on just one or two trades to push you through. Next up is position sizing. One of the biggest mistakes traders make is over-leveraging, taking on positions that are too large relative to their account balance. For example, if you have a $10,000 account, putting $5,000 into a single trade is risky because if that trade goes south, you could lose a significant portion of your capital. Instead, aim to keep your position sizes small and manageable, say no more than 1 to 2% of your account balance per trade. This reduces your risk and helps ensure that losses don't overwhelm your profit.
Right, so it's not just about picking the right trades, but also making sure that you're not putting too much of your capital at risk or any single trade. So smaller, more controlled trades lead to steadier results over time, right?
Exactly. By managing position sizing, you prevent any single trade from having too much when you will enter
The trades without a solid plan and end up making emotional decisions, right?
Absolutely, Aidan. It's so easy to get emotional in the heat of the moment. But if you have a plan, it's much easier to stay disciplined and avoid impulsive trades that could hurt your performance. Well, this brings us up to stop loss orders. A stop loss is an automatic exit that you set up to close a trade. If it moves against you, this helps to cap your losses on any single trade and protect your account balance. By using stop loss orders, you can avoid those catastrophe losses that can throw you off your profit consistency.
So I like the ideas of using stop loss orders. It sounds like a way to take the emotions out of the decision-making process.
Exactly, it's like setting up a safety net. Once your stop loss is in place, you don't have to worry about watching the trade 24/7. If things go south, the stop loss takes you out of the trade automatically, helping you stick to your plan and avoid large unexpected losses. Another important strategy is to regularly review your performance. Just because you set up a solid plan and strategy doesn't mean you should put everything on autopilot. It's crucial to check your trades, see what's working, and make adjustments as needed. You might find that certain markets or strategies are delivering more consistent results than others. By keeping a close eye on your performance, you can check your approach and improve your consistency over time.
So it's a performing maintenance or trading strategies, always looking for ways to optimize and improve.
Yes, just like a car needs regular tune-up, your trading plan does too. Continuous improvements is key to keeping your profit steady. Finally, and this is a big one, avoid emotional trading. Whether it's fear after a loss or overconfidence after a win, emotions can lead to poor decision making. And if you stick to your strategies and avoid chasing losses or getting overly excited after a good day, you'll see much more consistent results.
So that's such an important point, staying calm and disciplined when the market is going crazy. But it's easier said than done though, right?
Well, it's definitely tech practice, but staying level-headed is crucial for long-term success. If you can control your emotions and stick to your plan, you will be far more likely to maintain consistent profits.
So, alright, let's just dive into another crucial aspect of effective trading, the risk consistency rule. So this rule is key to maintaining both stability and long-term profitability in your FL. So rather than the usual gateway of explaining it, so can you walk us through what the risk consistency rule is and why it's so important for traders to follow?
Sure thing, Adam. The risk consistency rule is all about ensuring that you manage your risk in a disciplined, consistent manner. It limits the risk per trade to no more than 2% of your initial account balance. This is really important because it prevents large swings in your equity and helps mitigate the risk of significant losses due to sudden market movements or unexpected events. So let's break it down a little more. First of all, maximum risk per trade ideas. You shouldn't risk more than 2% of your initial balance on any single trade idea. This includes any floating losses, so you need to factor in on potential exposures. The next one is trade idea definitions. Multiple trades on the same assets in the same direction are considered as a single trade idea. On the other hand, trades on different assets or in opposite direction are treated as separate trade ideas. For example, if you own several positions on gold and buy, they would count as one trade idea, and the combined risk must remain under 2%. But if you have a gold buy and a GBP/GBY sell, they are treated as two separate ideas, each with their own 2% risk limit. Following this rule smooths out your equity curve, encourages disciplined trading, and most importantly, reduces the chances of massive losses.
So thanks to Rob, that's a really helpful overview. So now let's move through this back to your audience for a second. So traders, have any of you ever found it tricky to stick to the risk consistency rule? So how does it feel to have those risk limits in place, and does it ever get in the way of your trading strategy?
Well, the main points to remember about the risk consistency rule are: the first thing, the risk per trade idea. Stick to risking no more than 2% of your initial account balance on any single trade idea, and this keeps potential losses manageable and ensures you don't risk too much on any one trade. Next is a single trade idea definition. If you are opening multiple trades on the same asset or in the same direction, they count as one trade idea. So your combined risk must stay within that 2%. And next is separate trade idea. So trades on different assets or in different directions are considered separate ideas. Each of these can have its own 2% risk, but mindful to keep track of them. So what does this matter? It stabilizes your equity curve by preventing huge swings in your account balance, and it promotes discipline by encouraging traders to think more carefully about their risk. And most importantly, it reduces the risk of major losses that can really hurt your overall performance. So, in short, adhering to this rule helps keep your trading account safer and support long-term success.
So great, Alex. Now, I know that some of you might be wondering how to make sure you actually stick to this rule. So let's focus and get into some practical strategies for making it easier to follow. So, Rob, could you share a few tips on how traders can stay disciplined and avoid breaking the risk consistency rule?
Of course, Aiden, sticking to the risk consistency rule takes some planning and discipline, but it's totally doable with the right strategies in place. Here are a few key tips. First and foremost, clearly set your maximum risk for trade ideas to stay within the 2% limit. You can use risk management tools or calculator to help with this. Most platforms have built-in tools that allow you to automate risk limits.
So that's a good point, having the automation takes a lot of the pressures off, right? No need to constantly double check your platform does the heavy lifting.
Exactly, it makes it so much easier to stick to your risk limit when the platform is handling the number for you. So the next one is monitor position sizing. It's also important to keep track of the total risk across multiple trades on the same asset. For instance, if you own several positions on gold and high, make sure the combined risk for on those trades doesn't exceed 2%. This is where traders sometimes slip up. They open multiple positions without realizing that combined they are risking more than they intended.
So even though the trades are technically separate, if they own the same assets, you've got to look at them at one entity, right?
Exactly, and then treat them as one idea because they are all exposed to the same market movement. Speaking of different trades, it's equally important to treat trades on different assets or in opposite directions as separate ideas. This way you can manage each trade risk individually without exceeding the 2% rule on any single trade.
So right, so you could be going a gold buy and a GBP JVY zones at the same time without violating the rules, as long as you manage the risk for each one separately.
Exactly, just make sure you're keeping an eye on the risk for each idea individually. I would also recommend using risk management features that many trading platforms offer, like automatic position sizing or stop loss orders. These tools can help control your exposures and prevent you from overextending your risk.
So, and I imagine these tools really help prevent those moments when you tempted to take on too much risk in the heat of the moment, right?
Absolutely. It takes the emotion out of the equation and helps you stay disciplined. Lastly, make it a habit to regularly review your trading activity. This is something a lot of traders neglect. Reviewing your trades helps ensure that your risk per trade idea remains within the set limit. And if you notice any patterns or areas where you are taking on too much risk, you can adjust your strategy to stay confident.
So it sounds like regular check-ins are crucial to spotting potential issues before they become big problems.
That's right, Aiden. It's all about staying proactive.
So, so next up we are going to walk you through our streamlined payout process. So actually WeMasterTrade will believe it to make it easier as possible for you to access your hard-earned profits. So we offer various options for receiving your payouts, including bank transfer, PayPal, and cryptocurrencies like USDT, to ensuring the flexibility and convenience.
Well, our payout process is both fast and secure. After you've made a profit and met our payout requirements, you can simply log into your account, request a payout, and follow the on-screen instructions. Our team will process your request promptly, and in most cases, you can expect to receive your funds within 24 hours. Oh, that's simple. And if you ever run into any issues or have questions about your payout, our customer service team is always here to help you. And you can reach us via live chat, email, or through our support ticket system on the website. We are committed to ensuring a smooth and hassle-free experience for all of our traders.
So transparency is always a key part of our philosophy, and that's why we always need to help and answer any questions you might have about our account or the payout process. So feel free to ask in the comments. I will address your queries as we go. So next up, we'll introduce you to one of our very powerful tools, the financial instruments list of WeMasterTrade. So I hope that could help us understand more about this.
Well, welcome to the symbol overview page of WeMasterTrade. Here you can explore a comprehensive list of financial instruments available for trading, including cryptocurrencies, foreign stocks, metals, energies, and even indices. Our platform offers clients the opportunity to trade with demo accounts using virtual funds, and we also utilize exclusive algorithms to copy your trades to our live trading account. On this page, you will find detailed specifications for each trading symbol, including contract sizes, margin percentages, leverage options, and commission details. It's important to note that due to market fluctuations, some symbols may not always be available for trading.
So thank you, Ralph. So next up, we are going to enter the analysis for today's economic calendar.
So, for today's events, first of all, the manufacturing sale. The manufacturing sale measures the total sale value of manufacturer in New Zealand, a strong increase from 0.2% to 2.6%, signals robust industrial activity. For the potential impacts, financial markets positive for New Zealand's economy, boosting confidence in domestic manufacturing stock. And for forex trader, New Zealand dollar might strengthen against those currencies due to stronger economic performance. And lastly, for economists could indicate stronger GDP growth if the trend continues. The next event is the Westpac Consumer Sentiment. For the overview, this index measures consumer confidence in Australia, a significant jump from 0.1% to 4.0% indicates improved sentiment, likely due to better economic conditions or policy changes. About the impacts, first of all, in financial markets, positive for Australian equities, especially consumer-driven sector. Next is the forex trader. AUD could strengthen, reflecting improved consumer confidence. And the last one, economists. Potential increase in consumer spending, supporting economic growth. The next event is the household spending. Speak about the overview, a sharp decline in household spending indicates weak consumer demand in Japan. This could be a sign of economic slowdown, deflationary risk, or cautious consumer behavior. For the potential impact, the first one is financial markets. Negative for Japan's stock market, especially retail and consumer-driven industry. For forex trader, Japanese yens may weaken due to concerns over declining domestic demand, and for economists, could increase pressures on the Bank of Japan to maintain or expand monetary stimulus. The next event is the final GDP price index. For the overview, this measures inflation within Japan's GDP, are slightly higher than expected, 2.9%, indicate moderate inflationary pressures, which could support higher wages and spending. For the potential impact of financial markets, positive for Japanese equity if inflation remains stable. For forex trader, Japanese yen could strengthen if markets expect the BOJ to tighten policies. And the last one, economists. It may indicate a shift toward mild inflation, reducing deflation risk. That's the end for the calendar.
So thank you to our audience for joining us today. It has been an informative session so that you are excited about these promotion plan and the rules that we have here in place at WeMasterTrade. So thank you for everything, and we'll see you in our next promotions. If we don't live stream, so just to remember to like, subscribe our YouTube channel, X account and our Discord channel just to follow get up to date on the latest information and our promotions. So until next time, happy trading.